So good afternoon and welcome to our second quarter capital markets webinar. This very brief introduction, Manning & Napier is an investment manager headquartered in Rochester, New York with a 50-year track record of delivering positive results for our investors. My name is Jake Symoniak and I'm a Senior Analyst in the Global Strategies Group here at Manning & Napier. I've been with Manning for over a decade and I'm happy to be joined by Jay Wells today. Jay is the head of our core equities team and a member of the core team and investment policy group here at the firm. Before we move on, Jay, I was hoping you might talk a little bit about your time here at the firm and really the different roles you serve in now, kind of from the head of core equities to the IPG to the core team as well.
Sure. Thanks. Happy to be here, Jake. So I've been here for over 23 years, but I think more so than that, I've had some level of success in multiple positions over time that I think have ultimately prepared me for my new role as the head of core equities. So like Jake, I started off in the global strategies group, and that group's really a fantastic base because you're working on top-down macroeconomic overviews, and that's certainly come in handy in terms of my portfolio management and investment policy group roles that I have today. On top of that, I was a highly successful stock analyst in the tech sector for over a decade and a half. So I certainly was able to develop a deep appreciation of the bottom-up stock selection strategies that we've employed for over 50 years now. In 2015, I moved over and became the managing director of the technology group. I was running that sector group and also became one of the portfolio managers. Under my leadership, the technology group, I would say, was known for having a robust investment process and strong performance. And those are obviously things I'm looking to bring to the new head of core equities role. So I'm focused on initiatives like improving our portfolio management dashboards. So we always have the best information in front of us for making investment decisions, really flattening the communication between the sector group analysts and the portfolio managers and looking to accelerate decision making. But I think the good news is we have a really well-tuned research machine here. So these are really just incremental enhancements I'm making, and I'm just kind of standing on the shoulder of giants, if you will, and building on the half-century track record we have here.
Great. Well, I appreciate that, and congratulations on the new role. So from here, I think there's three things I really want to accomplish today. First, we're going to go through kind of our overview, where we see markets and where we see us going from there. But I think in order to do that, we really want to set the stage and talk about where we've come from. After we do that, we'll do something of a deep dive on positioning in the equity portfolios and really focus on a couple key sectors and industries that I think are of particular interest right now, and where we've been getting some questions from investors as well. And finally, we'll leave some time at the end to take questions that are submitted through the Q&A feature. So if you guys have any questions at all during the presentation, feel free to let us know, and we'll answer those the best we can. So Jay, with that, before we start talking about where we are now, kind of where we think we're going from here, I think it's important to set the stage. And maybe you could talk a little bit about kind of what we've seen over the last several years that led us to where we are today.
Absolutely. So prior to COVID, we already had the Federal Reserve hiking short-term interest rates, and there was evidence at that time that the economy was already poised to slow. And when the pandemic hit, I think it's fair to say there really was an unprecedented wave of global monetary and fiscal stimulus that was unleashed. And if you go back to the COVID time period, there was legitimate concern about an economic crisis and how deep that might be. And I think it's fair to say the authorities brought out the proverbial policy bazookas, if you will, to avoid a worst case. And on one hand, you could say they kind of accomplished the mission and that the COVID-induced recession was pretty sharp, but it was relatively short-lived.
Yeah, there's no question, but like anything else, right, it came with a price. And what we did witness after that was just a massive inflationary surge, whether you measure it by what we saw in the real economy and also what we saw in financial markets. So if you could, maybe you could talk a little bit about what we're seeing now on the inflation front and kind of what it took to get where we are.
Right. So I think it's fair to say there was, too much stimulus. Interest rates were held, too low for too long. And there was really the result was a dramatic increase in inflation, levels we haven't seen since the 1970s, 1980s. And beyond that aggressive stimulus, there are other compounding factors such as, a surge in reopening demand, supply chain and labor shortages.
Yeah, and I think what we can say is when we look at past inflationary periods in the US, right? I think about the 40s and 50s, I think about the 1970s, and I think about what we see now. I think that there were common features that we saw in all of those. There was a fiscal shock, which we saw. There was a monetary shock, which we saw. And then there was an exogenous shock, which we saw, right? It was World War II at one point. It was a massive spending plan in the 60s into the 70s. And here it was the response to COVID. And while all those situations were a bit unique, the outcome was the same. So what we saw was kind of generationally high inflation. And in order to tame that, we saw the Fed embark upon one of the most aggressive tightening cycles we've seen for quite some time.
Yeah, exactly. So yeah, I think we went from a period during which, when we were in the COVID timeframe, the primary risk really was one of economic crisis. And if you think what the incentives were at that time, it was to err on the side of overstimulating the economy, if anything. And if you go to current day, I'd say the dominant risk is of inflation expectations becoming entrenched. So you can see here the Fed has been aggressively tightening interest rates, trying to reestablish its inflation fighting credentials to try to avoid a 1970s type scenario. And it's kind of a glass half full, glass half empty, in that the bright side of it is we expect the Fed is ultimately going to win the war and tame inflation, but rate hiking cycles tend to lead to economic recession and bear markets.
Yeah, and I think kind of piggybacking off what you said, the positive thing that we've seen so far is that unlike what we saw in the 1970s, inflation expectations have not yet become unanchored. So whether you look at market pricing, whether you look at surveys for consumers, surveys for businesses, we don't have the unanchored inflation expectations that we did then. The problem is a lot of that has been caused by the aggressive tightening cycle that we have seen, by the fact that we've seen the Fed hike faster and higher than really in any cycle during our lifetime. And I think the thing to keep in mind with that is that it's now leading to a situation where a recession is becoming increasingly likely.
Yeah, to your point, Jake, there are several reliable indicators, and whether it's the lead economic indicators, as you can see on the slide here, or yield curve, or as we'll see on the next slide, loan officer surveys of lending standards, where these really kind of reliable key indicators are at levels that where it'd be unprecedented if we didn't have a recession. And so given that backdrop, we believe it's makes sense to be positioned defensively and play for capital preservation given the risks.
Yeah, and I think the key point here is that the future is unknowable, right? Like if we knew if a recession was coming, if we knew it wasn't, we would obviously have a tremendous advantage and know exactly what to do with the portfolios. But the best that we can do is kind of take the information we have, look at past cycles, and think about the probabilities of what we see coming. And when we look at the indicators that tend to have the highest hit rate for predicting past recessions, things like the CLI that we're looking at here, things like the yield curve, things like bank lending surveys, the highest probability outcome in our view is recession. And we just don't see that being in the market at all. It certainly feels like we've been a bit early with that call and getting defensive in our portfolios. Performance has suffered, for a little bit now because of that. And we can talk about the reasons that the economy has held up well, but it's important to remember the adage that, monetary policy acts with a lag.
Yeah, to your point on lags, it certainly feels like, a very slow developing recession. It feels like we've been waiting for a long time. And frankly, we have been probably for, something like a year and a half now. And with unemployment being below 4%, market that's up 15% plus this year, I think a fair question is what recession. People just aren't seeing it.
Yeah, it's it's certainly a question that we've been asking a lot here. It's something we continue to ask and something we will continue to ask. And I think one of the things that we've been trying to do is really figure out why we might have been a little bit early on that. And I think there's a lot of things we can talk about, a lot of things we can think about. There's the lagged effect of consumer stimulus along with the significant wage increases we've seen. And when you think about, the percentage of the US economy that is represented by the consumer, it stands to reason that if the consumer is, seeing the impacts of fiscal stimulus, getting wage increases, they should be able to continue to spend and the economy can remain resilient. We've seen construction hold up pretty well, not only on the back of housing potentially finding a bottom, but you've seen corporate investment, manufacturing, construction remain pretty strong with things like the Inflation Reduction Act being supportive, the CHIPS Act. And then I think the other thing that's been important is corporate profits have held up well. And a lot of that has to do with inflation, right? If companies have pricing power and they can pass that on to consumers, it's going to be a little bit before profits start to fall and those companies can continue employing people that might have been difficult to find, so they're reluctant to let go. They can continue to invest. But with all that said, we continue to see signals of a recession coming. And it's, we're starting to see cracks in manufacturing. We've seen cracks in interest rate sensitive parts of the economy, and we're starting to see cracks in the labor market as well.
Yeah, I want to go back to your opening point there on lags, and I just think it's really important to keep that in mind, that monetary policy kind of works its way through and hits the economy with the time lag, and there indicators like unemployment that are lagging, and we're only going to see unemployment start to spike when we're in the depths of a recession, and it'll be too, the market will already have moved and it'll be too late to get defensive at that point. So the chart on just on lending, tightening, I think it's helpful just kind of talking through the mechanics there, and that as rates rise, that hits loan supply and demand, which ultimately hits economic growth. And we're already seeing banks starting to tighten lending standards as delinquencies are rising. So there's pressure on lending supply from the banks. And then on the demand side, there's indications that consumers and businesses are starting to pull back, and there's less demand for credit, because a rise in rates leads to higher interest expense. So it's really on both sides there and ultimately filter through to the economy.
Yeah, I think that dynamic that you mentioned in terms of the supply and demand of credit, the rising cost of credit, is going to be something that's particularly important to think about, given the weaknesses we're seeing in certain spaces in the economy, particularly with commercial real estate. When you think about the wall of corporate debt that's going to need to be refinanced in the coming years, there's certainly the potential for something to go pretty wrong. We're not saying that we think something will go pretty wrong, but when something breaks like that, when something doesn't go as planned, that's typically when you see those hiking cycles come to an end.
Yeah, and that's why I think playing for capital preservation at this point, as you can see in this chart, we feel like it's warranted, not just because of the recession call, but also tightening cycles tend to be capped by a crisis. We've already seen several banks fail. And I just want to be clear, it's not our base case that we're going to see a financial crisis, but we're clearly in the part of the cycle where there are elevated odds of a crisis happening.
Yeah, and I think that way of thinking, that way of saying it is exactly right. What I've been saying is it's nearly impossible to know what is going to break. It's difficult to know where something is going to break. It's difficult to know when something is going to break. What's significantly less difficult to know is the type of environment in which things can break. And I think we're certainly in one of those environments now, right? We've had the most aggressive hiking cycle we've seen in our lifetime. You think about the potential banking crisis that we saw in March. Now, the Fed and a handful of federal agencies did really well, right? And they deserve credit for that. They stepped in, they backstopped the banking system, they prevented significant contagion in March. But that doesn't mean we're out of the woods by any stretch of the imagination at all. And I think that those risks, those downside risks, are what's important to think about right now, and kind of what's in the back of our mind when we're positioning our portfolios. So I think before we go on from there, I just really want to recap, right? We came from a position where COVID had the potential to be a very, very significant economic disruption with problems that really, it's hard to even imagine how it could have played out. We saw a significant policy response, which led to inflation, which in turn led to a generationally aggressive tightening cycle from the Fed. And at this point, we see significant downside risks to the economy. And I think the question I would put to you, Jay, is do you see that in the market right now?
No, that's a major problem. You could, here's a chart where you can see in the dark green line that consensus is expecting a fairly significant ramp in earnings growth, into 2024, 2025. Whereas, in a recession, what would be more typical would be to see earnings fall 20, 30%. And that's, we have an illustrative case in the lighter green that, gives you a feel for there's a pretty big difference between what's in market expectations and what we think is a more likely scenario. And we certainly become more enthusiastic if consensus expectations, were to be more realistic and look something more like the illustrative case here.
Yeah, I think the important thing to keep in mind too is when we think about those expectations that we believe are elevated, it's not necessarily set against the backdrop where valuations have become really compelling.
Yeah, the way I would put it is it seems like the market consensus right now is that we're going to have an economic soft landing. The Fed's going to stick the landing, and they'll avoid a recession. I think that there's low odds of that happening. And when you look at market valuations, we feel like they're fair at best. You can see it in the price to earnings chart here that it's the right around average. And whether it's as stocks as you see here, or if you look at high yield bond spreads, it's the same story of a market that's not pricing in a lot of risk at a point when we think risks are quite elevated.
So I guess on that point, I hesitate to ask you directly how much downside is there, because that's asking you to predict the future in a way that you quite simply can't do, right? If we knew that, this job would be a lot easier. But when I think about, the fact that typically in an environment like this, the market can rally kind of through the end of a hiking cycle, even after that last hike. And when you tend to get a bottom in a more adverse economic scenario is actually after the first cut. What sort of upside, downside, risk reward do you see in the market right now?
Yes, it certainly won't be foolish enough to try to make a market point forecast, but you can see here in the dark green that, if you just historical precedent, we could easily see the market fall 20% as the Fed, starts to cut. And I think the other way to look at it is, the prior slides, there's not a lot of valuation support. We certainly could see, the price to earnings multiple fall double digits. And I think, and we mentioned earnings, could also fall 20%. So, I think something on the magnitude of 20% plus is not out of reason.
Yeah, and I think it gets back to that point we talked about earlier, right? Like, you look at what's being priced into the market right now, you look at forward expectations, we're pricing in 3 or 4 cuts by the end of next year, but the Fed doesn't tend to cut unless something goes wrong.
Yeah, the Fed transitions the cutting after they've realized generally they've tightened too much and the economy's already slowing. And we're at the point where we believe there's going to be several more rate increases, but we're rapidly approaching that point of maximum danger where the market's prone to large drawdowns.
So I think before we go on from here and start to get to a more portfolio specific discussion, maybe you could just sum up kind of where you see things today and broadly how we're positioned kind of across our portfolios before we start taking more of a deep dive into specific sectors and industries.
Sure. Bottom line, we expect a recession. There's, I'd say, an elevated risk of a crisis, although that's not the base case. And market valuations certainly don't reflect the risks. But that doesn't mean you should just pull all of your money out of the market. If you look at the chart here, you might think, given our backdrop, it's might be opportunistic to try to go all cash, but it's nearly impossible to pull off in practice. And you see all this green on the right here. There are really big major rallies following recessions. And we think the better approach is to get more defensively positioned, but in a measured manner and remain flexible going forward. So in our multi-asset class accounts where we can own a combination of stocks and bonds, we currently have below average, below midpoint exposure to stocks. I would point out, we're not in a TINA environment. There is no alternative environment where you're forced as an investor to own equities because yields are so low. Bonds now are a pretty attractive place to camp out and clip that yield. And I also think it's worth mentioning that you should expect us going forward as we progress through the cycle. You're going to see us adding equities and buying more cyclical stocks as we enter a recession, we see some panic and valuations get more attractive.
So I do want to talk about some of those areas where I think we're going to be adding in the future. I do want to talk a little bit about how the portfolio composition is going to change through time as we move through the cycle. But before we get there, when we think specifically about the equity portfolios right now, can you talk a little bit about the types of companies you're looking for?
Sure. So we have, one of our strategies is the profile strategy. And so, there are companies that have deep competitive moats. They have barriers to entry, strong brands, and, they're, kind of your proverbial Rip Van Winkle or coffee can stocks that, these are companies you could have put away for 10 or 20 years, obviously at the right valuations, and they're going to be, great companies, they're durable. They'll, 10, 20 years from now, they're still going to be fantastic franchises. And, those are, more defensive stocks. They tend to have more stable revenues. We're focusing on strong balance sheets and good cash flow generation. The profile strategy fits tend to be companies that are resilient to inflation because they're able to pass through the cost input inflation that we're seeing right now and through raising prices. And then, additionally, you're going to see us be more opportunistic, with some of the other strategies. So the hurdle rate strategy allows us to buy, companies that are cyclical. So there are areas like semiconductors, certain housing related stocks and insurance where, we've seen a cyclical downturn in fundamentals, and we've more, just as importantly, seen that priced into the stocks, unlike in the overall market. And so we've been opportunistic in picking some of those off, and going forward, I think you'll see more of those sort of purchases.
So before we move on from that, I do have a question for you. We've talked a little bit about defensiveness, and I think when people think about defensive stocks, there's certain industries, certain sectors that come to mind. And to a large extent, that's right. But I also think that one of the things we're looking for are kind of more defensive businesses, right? More defensive cash flow profiles. Can you talk a little bit about what defensive means to you within that context?
Yeah, so I'd say defensiveness, what it means to me with the profiles, again, they're durable franchises that are going to be around for a long period of time. They're safe from the balance sheets are strong, and they have, durable cash flows. And so, those are really where you're seeing us hunker down right now. In a recession, I would expect you're going to see us to transition the portfolio, incrementally towards the other two strategies we have, which are hurdle rates, that's our cyclical strategy, and then bankable deals, which are our deep value strategies. And I think it's fairly intuitive, right? Like hurdle rates, you're going to see demand get hit, and a gap open up between supply and demand. Profits are gonna fall, and that's right when we want to be buying those industries, when there's maximum pain, they're starting to rationalize supply. And coming out of recession, the supply and demand will tighten and profits will improve. And bankable deals being a valuation based strategy, when you enter a recession and the market gets hit, there are more value opportunities out there to pick off.
Yeah, so I think the key point maybe that I would make on that to kind of wrap that discussion together is that, as we've talked about now, we kind of have our three investment strategies, right? We have the profile that Jay, you talked a lot about. We have the hurdle rate strategy that allows us to kind of invest consistently and within our process through deeply cyclical industries, kind of through a cycle. It tells us when to get in, typically early, when to get out, typically early as well. But it's really about taking advantage of opportunities while preventing risk, and also the bankable deal, which is kind of a deep value strategy. And I think the thing you did a good job of elucidating there is how, as we move through the economic cycle and the market cycle, investors who have been with us for a while know this, they understand this, but we should expect the composition of the portfolio to change from a strategy perspective with time. Now, I guess moving on from that, and we've alluded to this a little bit, kind of, what we would do as we move through the economic cycle, as we move through the market cycle. What is it that you want to see to get more bullish at this point?
Yeah, there's, I think, two ways we could get there. Price and conditions, we like to say. So on the price side, that's valuation. So I think if we saw more reasonable expectations in the market, and if valuations were to price in the risks that we see, then that would allow us to be more opportunistic. And that's, I think, to use an analogy with some of the bottom up stocks that selection, you've seen us get opportunistic in cyclical areas like housing and semiconductors I just mentioned, where we've seen that happen. The risks are priced in. The second way is, look, we could just progress through the economic cycle and the rate hikes ultimately push us into a recession. The Fed starts cutting and there's blood in the streets and we have a panic, and we buy into that pain. That's the other way we could get there. And they're not, to be clear, they're not mutually exclusive either.
Yeah, I mean, that's kind of what we've always thought about as the best time to buy stocks, right? When rates are falling, when the economy's falling, when the stock market is falling, that's kind of the proverbial when there is fear, you want to be buying. And I think that's the opportunity that, we think there's a reasonable probability that we are presented with that opportunity in the future, given our view, given the risk reward that we see in the market, and kind of given the aggressive tightening that we've seen from the Fed. So I think with that, we'll probably wrap up the conversation on how we're positioned today, and maybe move on and really kind of lever your expertise as a PM, and specifically from your time in the technology sector, to talk about a couple different industries. And I think, what we're going to talk about tech, and specifically AI. We're going to talk about banks, and we're going to talk about housing. And I think the thing that's interesting about all of these different industries, all of these sectors, is that they're significantly different, right? We think about technology, we think about growth companies, we think about structural tailwinds. We think about banks, and it's kind of a very cyclical industry that's right in the crosshair of a lot of what's going on. And we move on to housing, and it's kind of like a combination of the two, right? You've got some secular tailwinds in some areas. At the same time, it's right in the crosshairs of the Fed's aggressive tightening cycle. So I think it's hopefully it's a fairly interesting grouping of industries to talk about. And with that, Jay, I think maybe we just get right into technology and kind of what you're seeing in that space.
Sure, happy to talk about that. It's, as you noted, an area that I was an analyst in for, quite a period of time. So it's very interesting to me. Certainly a lot of excitement right now around generative AI, and we do have meaningful exposure in the portfolio. So we own several AI providers, and these are companies we'd be familiar with as the large internet companies, the cloud computing companies. We also own a handful of AI suppliers, and these are going to be primarily semiconductor companies, but they're also the data centers where the servers and semiconductors to run the AI sit. And then we have, even more companies that we consider to be AI beneficiaries. So they're going to leverage AI to grow revenues and maybe even to reduce costs as well. And the examples I'd give in the portfolio would be software as a service companies, video gaming companies, payments, e-commerce, and defense contractors.
So I guess I would ask you very bluntly and kind of point blank, would you say that we own these companies because they're linked to AI?
So, I want to be upfront that we're not chasing the trend here. We didn't it wasn't the case that generative AI hit the headlines and we ran out and bought a bunch of AI beneficiaries. These are stocks we've owned for an extended period of time. We own them because they're strong strategy fits. Anything to get in the portfolio has to fit one of the three bottom-up strategies. Like we do think AI is a kicker for these companies. We've been monitoring AI for a long time, so this wasn't something that caught us by surprise. But it's not the primary thesis here, and it's maybe worth mentioning. We do with tech profiles in particular look for platform companies that can bolt on additional revenue streams over time. So this upside optionality for AI was certainly something that we had accounted for, but it wasn't the overwhelming driver here.
Why do you think that this generative AI has received so much attention?
Yeah, why? It's a good question. Why has it received so much attention? And I would even add, has it received too much attention? Is it again a bit overhyped? And I think, to answer your question directly, I think it's you don't have to be a programmer to use this. It's probably one of the more salient technologies from a consumer perspective, in that you can just go to visit ChatGPT through a website or an app, and you get this these amazing results that feel very, very human, even though the way they're generated is just a very mathematical, programmatic nature. And so to move on to the hype aspect of it, we do think absolutely there is massive long-term potential here, and we've long believed that. We don't think the long-term outlook's overhyped, but I do think the market in some cases hasn't discriminated enough between who the real AI beneficiaries are and some companies that people are just kind of jumping on the bandwagon with a hope strategy. And I do think there's also an underappreciation for the fits and starts and potential pitfalls there are along the way. So, if you think, back on AI, it's a very long-term trend. AI, has been around since the 1950s, and what we've seen is various AI winners or cycles, if you will, and it's been a case where various algorithmic approaches they're hyped during the when they first take off, and they're going to be the end all be all, and then they max out. And when you look at things like hallucinations and the errors that generative AI makes and some of the roadblocks out there, I think it's unlikely to be the ultimate solution, and we just have to be careful to be realistic about the time frame over which this is going to take place.
Yeah, I appreciate that a lot. So I don't know, unless you have anything else to say on tech or AI more broad, I guess more narrowly, we can move on to banks.
Sounds good.
Okay, so banks are an area, as we mentioned, that have kind of been in the crosshair of a lot of the stresses that we're seeing in the system right now. And I think it makes it an appropriate time to really dive into this topic and talk about maybe not only what we see in the banking space broadly, but maybe more narrowly kind of how we think about banks at Manning & Napier, and when we may or may not look to increase exposure, to that industry in the portfolio.
It's certainly topical for all the reasons you mentioned. It's an area that's seen several, a series of failures this year. Silicon Valley Bank, First Republic. We were already underweight banks in the portfolios when we entered the year, and after the failure of SVB, we quickly got even more so. We expect it's going to remain a difficult environment for banks for a period of time, and they're kind of getting hit on both sides of the balance sheet, if you will. So banks had considerable portfolios of long-term fixed income securities from when rates were really low, and as interest rates backed up, they're experiencing large unrecognized losses on those fixed income portfolios, and that wouldn't be problematic if as long as they can just hold those assets to maturity. The problem is high interest rates have also pushed up money market. The funds being paid on the interest rates being paid on money market, which is competition for bank deposits. And so you have depositors pulling money, some combination of finding more competitive rates out there than what banks are offering, or just outright, bank runs because they're worried about the crystallization of the unrecognized losses. So, that's led to a couple failures, and there's potential for more. The next thing that could hit the banks are, their loan portfolios turning for the worse. We've already seen delinquencies start to pick up, and you would expect that to get even more accentuated in a recession. There are pockets like commercial real estate that look, at risk. That's a market that remains depressed with, the kind of this new work from home hybrid environment that we find ourselves in. And then we've certainly talked internally about the potential that there's a repeat of a 1980s savings and loans crisis, this time with the regional banks. So there's certainly banks are at valuation levels that are, they're starting to look interesting, but it's still a very I'd say an environment that's very fraught with fundamental risk.
Yeah, I think banks are an interesting industry to talk about within the context of this conversation for a couple different reasons, right? So you think about something just that's broad and overarching, and it's that competition for capital that's kind of come up a couple of times. And really, banks haven't had to deal with that for a really long time, right? Where people were actually looking at real alternatives where they could earn yield on their money, and you didn't have to put your cash in a savings account that was essentially earning zero. You can do something other than that. What does that mean for bank deposits? We talked a lot about the economic backdrop. We talked about risks in areas like commercial real estate. And again, the banks are just really, really at the center of all of that. But I think the other thing that we talked about a couple minutes ago was how the composition of the portfolio might change through time. And as we move through an economic cycle, do you see banks potentially being an industry where we could add exposure with time?
Absolutely. It's an area that we've seen the sector team that covers banks. They've been doing the groundwork there. They've, both just kind of dusting off the general cyclical strategy and how you could play banks, but also working on individual names. And it's an area where I think the valuations are getting there, but there's still, fundamentals we think are going to deteriorate for a period of time. But as we start to progress through that, and you get, probably some more bank failures and some more panic, I do think that's an area where there's the potential for us to go, from being very underweight to more market weight to maybe overweight in the banks as we enter a recession.
Yeah, and if I could, before we move on to housing, I think you made a point there that I would want to highlight. Maybe if you have anything to say on it, great. If not, we can move on to housing. But you talked about how the analysts right now, specifically on banks, are kind of doing that work and laying the foundation now, right? And I think about something like generative AI and some of those tech companies. And it's not that we're not interested because of the valuation. It's just when we think about why we buy securities, right? We have our strategies and we have our valuation disciplines. And just because something is a strategy fit doesn't mean it's the right time to buy it. So can you talk about, maybe just briefly talk about the fire drill list and how something like that could come into play kind of in the coming months as we move through the cycle?
Sure, happy to do that. So our fire drill list is each sector group has a list of stocks that they've done the work on. So they have a buy rec, a financial model ready to go. It's been presented to the group. The strategy fit's been presented. So it's a list of stocks that they know at the right price or conditions they want to buy. And if you go back to the COVID time period, that may be a great example of how kind of the rubber hits the road, if you will. When we saw, that was a really quick panic like that was a really, this feels like kind of more like a slow burn into a recession right now that we're experiencing. Whereas, back then it was a matter of days or weeks where the market crashed. And because we had all those stocks ready to go on the fire drill list, we were able to be extremely active and reposition the portfolios more aggressively in a really short period of time during COVID. And that's what we're trying to lay that groundwork right now. The portfolio managers have been asking the sector teams to dust off more cyclical ideas, and we have a playbook ready to go. What would we, we're not looking at just, where are we today, but 6 months out, 12 months out, where would we expect the market to be, the opportunities to be, and we're making sure we're ready to go on, we kind of have those in our shopping basket, if you will, and we're ready to, roll up to the counter and purchase those.
Yeah, I appreciate that perspective. And I think that kind of that insight to how our process works and maybe how we've been able to act quickly in past instances, how we're going to be able to act, as our views evolve through time, as we move through the cycle. I think that color is really useful. And I kind of sprang that on you, but I appreciate you being able to weigh in and answer that for us. So kind of getting back to the conversation that we were having before, we've talked about tech, we've talked about the banks. And I think the last industry we can get to is housing. And again, I think there's some interesting dynamics at play in housing that it stands out to me in the portfolio for a couple of reasons, right? It is an area that's been hit by interest rates, but I think it's provided some opportunities. And we talked a little bit before about kind of some more defensive type companies and how that doesn't necessarily mean defensive sectors. And I think this is an area of the market where we've been able to find some of those companies that have some of those defensive properties that we're looking for in a pro-cyclical sector.
Yeah, we've been able to buy some really great companies. They're the power tool makers, distributors of home supplies like plumbing that, they're down dramatically because the backup in mortgage rates has just crushed housing affordability, and there's very weak fundamentals now. And these are really good companies that are going to come out the other side of this. And this I'd say is a good microcosm of what we're looking for in a broader sense. We go forward is as the fundamentals are really weak and there's pain out there, and people don't want to buy these stocks. We're going to step in, buy these great companies at discounted prices. And I just to put a bow on the housing play here, I think it's worth talking about the undersupply that we're seeing coming out of the housing crisis. There's been a relative dearth of new home building, and so we think this is going to be a very different downturn in the housing market as compared to that cycle. And we think it'll be relatively short because there's just not a lot of supply out there, where the U.S. is actually pretty short housing stock. And so that there's the stocks they're experiencing pain right now, but we think that'll be relatively shallow.
Yeah. So we do have some questions coming in that I think I'd like to try and get to and answer. And this tends to be a favorite that we get often, kind of given our positioning and again thinking about how we employ the hurdle rate strategy through time. Do you have any broad thoughts just in terms of what we're thinking about energy right now?
Yes, energy, that's going to be an area that we will play with the cyclical hurdle rate strategy. So right now we're actually zero weight energy. We think it's a kind of a particularly dangerous time, and we're kind of at the rolling over point of the cycle. And so I would parse it into supply and demand. And so on the supply side, we are starting to see the rig count, starting to see drilling roll over, but it's from a high level. Supply, we were just talking about this in the sector group meeting yesterday. There's still net supply growth right now. I think people maybe get enthused about what OPEC's doing and that OPEC's pulling supply, but I think in a hurdle rate you have to consider how quick supply can come back on. It's one thing if it takes a year or 3 years to start drilling again or bring a copper mine back on, but the OPEC supply, there's not a lot of discipline there. They can bring that back at any given moment. They're not actually taking supply out, they're just holding it back, and there's a lot of cheating that goes on. So we think the supply outlook, we really need to see more pain in the industry, more losses and supply coming out, and to hit the demand side really quick, it should be, I think, fairly intuitive that if you have a call that there's going to be a recession, energy demand is very cyclical. Demand would be expected to shrink. That's going to open up a supply demand gap. You're going to see weaker profits and weaker stock prices. And so, we do think there will be a fatter pitch down the road. We think the hurdle rate is likely to set up if our outlook proves correct. So, I think, Jake, you and I are doing this. If this call was 18 months down the road, we might be talking about being double the benchmark in energy, right? But it's, today I think we're, at a very dangerous point where the market's still deteriorating and likely to get considerably worse. So potential opportunity going forward, but too early today.
Yeah, and I like the point that you made on kind of how quickly the allocation to a sector industry like that, specifically within what we consider a hurdle rate industry, can change, right? We don't necessarily think we have to incrementally add. When the conditions present themselves, it's something that we're willing to hit hard. And again, we used the example of 2020 kind of coming out of COVID. I think the way that we positioned in energy back then is another good example. So, I want to be cognizant of everybody's time here. I do want to take one more question because everything we've talked about so far has been pretty focused on the US. So kind of a broad question here, Jay, and I'll let you go with it wherever you want. What's our outlook for international equities right now?
Sure. So I'll hit it at a high level, and then you're certainly the international expert. So I think people would probably love to hear from you on maybe some of the country or regional specifics. So just a real high level, overview. We tend to be more overweight US versus international right now, or to have that skew. And it's, the US is a more defensive market, which fits with the overview. If you were to talk to the analysts, it's certainly a lot easier for them to find great profile strategy fit franchises in the US. It's harder internationally. I would point out that we've seen kind of the valuation spreads blow out, where I think certainly international valuation looks really attractive right now to the US. And so I think as we progress through an economic cycle and as we start to look to play more offense versus defense, I think that, like energy, that's another area where this is likely to be a very different conversation 12, 18, 24 months down the road. And I think a lot of the incremental purchases will be international in nature. But I guess just maybe similar comments to energy, where it's teeing up, but maybe just generically talking about international, just a bit too early today to pivot in that direction.
Yeah, and I think I'd kind of pick up where you left off, right? I think about past cycles, what we've seen, how we've positioned, and there are certain things that you tend to see at different parts in the cycle, right? And one thing we see early cycle, the dollar tends to weaken, commodities tend to do well as economic activity picks up, which tends to benefit ex-US markets. And because of those dynamics, whether it's flows kind of moving from more defensive markets to more pro-cyclical markets, whether it's foreign currencies appreciating to kind of give you that boost, and even sector composition within some of those markets, right? They're much more geared to cyclical markets. You tend to see international equities outperform early cycle. So as we move through the cycle, I do think you should expect to see us increase our allocation to those international, to international markets. Now, I think that there are some pretty interesting questions that, we're asking internally. There's interesting conversations that we're having specifically on some of the major markets, right? And I don't want to be too long-winded here, but when you think about kind of the global economic cycle over the last, call it 2 decades, the major kind of economic focal points, the major economic centers of the world were moving in a pretty synchronized manner, right? They'd move through the cycle kind of in tandem. And COVID and policy responses to that, it kind of jarred that dynamic. And when you look at where we are now, we're talking about the US and how we think we're heading into a recession. We look at Europe, and Europe's already in recession, and they continue to hike. And I think the question is, okay, is there going to be a policy mistake here that could potentially put us into a much more significant downturn? and maybe European equities won't be as attractive as they have been in the past. Now, maybe they will, but it's a conversation we're having. It's something we're monitoring, and it's something we're going to have to, think about moving forward. And then you keep going, you keep moving that direction, and you look at a country like China. China didn't have nearly the policy response that some of the Western economies did. But what China did have is manufacturing capacity that kind of produced what everybody needed. So they didn't have to respond in the same way, right? They exported their way out with PPE, with computers, electronics, things that people needed as they worked from home. But again, we're in a situation now where as global demand has faltered, China has moved to stimulating the economy. So they're much more early cycle. And we're starting to ask questions about local government financing vehicles, their ability to stimulate, whether or not the transmission mechanism that has existed for years and years in that country can continue to function the way that it has. So I guess to put a bow on this, to wrap it up, I would anticipate, like we said, early cycle, we're going to be adding to international equities, but as is the case every time, I think there's some pretty serious questions that we're asking ourselves and some dynamics that we're going to have to consider and kind of monitor as we move forward. So I don't know, Jay, do you have anything else or?
No, I think that you pretty well covered it.
Okay. So, with that, I think we've come to the end of our time for today. I want to thank everybody for taking the time out of their day to be here with us. If we didn't get to your question, we'll be sure to follow up with you after the presentation. As a reminder, for your convenience, a recording of this webinar will be emailed to you shortly. And please feel free to continue reaching out with any questions or follow-up you might have. We'd also really appreciate it if you could take a few minutes and fill out the survey that we've linked in the chat if you feel so inclined. And if you're someone who likes to plan ahead, feel free to go ahead and register for our third quarter webinar as well. So Jay, thanks for being here today. And to our listeners, thank you for taking the time and attending today's webinar as well.
Thanks, everyone.